Welcome, dear traders. Fresh economic data from China and yesterday's drop in Wall Street stocks supported Asia-Pacific markets. In addition, a survey in Japan showed that sentiment among manufacturers deteriorated sharply in January. Meanwhile, oil prices, to which commodity assets are tied, plunged even as fears of escalating tensions in the Middle East increased. Let's see how Asian currencies reacted to this and other events today. A series of statistics released in China today confirmed the uneven recovery of the world's second-largest economy. However, China's GDP growth is still above Beijing's target of 5%. In the fourth quarter of 2023 and throughout the year, China's GDP climbed to 5.2%. Although it was lower than forecast, the results were a modest rebound for a shaky start to the year. Nevertheless, it was a slight strengthening. Other data released on a Wednesday was mixed. For example, retail sales dropped and fixed investment picked up. However, the unemployment rate also increased. At the same time, China's industrial production accelerated to 6.8% in December and showed the sharpest growth since February 2022. All these reports confirm the fact that the country's economy looks fragile and still needs support from the authorities. Concerns about Japan's fragile domestic consumption have been exacerbated by weaker external demand, particularly from China. Since the New Year's earthquake, the country's authorities have been confronted with lower inflation and weaker wage data. In January, the producer sentiment index halved to 6 from 12 compared to the previous months for a variety of internal reasons. The Bank of Japan's chances of abandoning its negative interest rate policy have diminished significantly, and the country's currency has depreciated. In addition, the yen came under pressure from a soaring US Treasury yields and the US dollar. Yesterday's speech by the Fed representative seems to have reassured markets that the regulator does not intend to act aggressively. Known for this dovish stance, Christopher Waller warned that the strong state of the US economy and the labor market would allow the regulator to gradually reduce interest rates. I see no reason to move as quickly or cut as rapidly as in the past, Waller said. His comments echoed hawkish comments from European Central Bank officials earlier in the week. Most of the US regulator representatives also spoke in the same tone. However, it was Christopher Waller's hawkish stance that caused the markets to reconsider their expectations for the US rate cuts. As a result, Waller's speech supported US Treasury yields and the US dollar, and the US currency moved sharply higher against its six counterparts during the US session and continued to climb within the daily range of 103.20 and 103.60 in Asia today. Despite the fact that China's state-owned banks began selling dollars for yuan at Wednesday's market open, the US currency held near its one-month high during the Asian session. In this connection, the bullish scenario could continue and push the greenback toward the 103.5 resistance level or even higher into the area of 104.00 and 104.20. In addition, the yield on the benchmark 10-year US Treasury note is holding steady above the 4% threshold, providing a tailwind for the US dollar. The US dollar's movement against the yen overnight showed that the yield on the US government bonds continues to have a major impact on the Japanese currency. It has already fallen by 4% since the beginning of January, and the downtrend may continue, with the Bank of Japan staying on the sidelines until at least March or even until the mid of the year. The country's currency still has a little chance to strengthen. That's why its rate against the US dollar surged to its 6 months high within the range of 147.9. On the daily chart, the dollar-yen pair continues to maintain a bullish momentum in the boundaries of 147 and 147.90 today, and the Japanese yen may test the level of 148 and the resistance area of 148.50 and 148.80. Later this week, Japan has released consumer deflation data. If the data shows signs of easing price pressures, the yen may have a chance to strengthen. Against the backdrop of geopolitical turmoils, falling oil prices, and mixed data from China, the Australian currency remained almost without growth opportunities today. The Aussie was trading within the bearish area between 0.6540 and 0.6660. The Aussie's losing streak may continue against the backdrop of the US currency's further strengthening. This means that the Aussie may find the 0.6530 support area and fall below 0.65. On the other hand, a break above the 0.66 barrier will help the Aussie dollar pair advance towards the major technical resistance level of 0.6650. However, the charts of the antipodean currencies show that we should not expect a bullish reversal against the US dollar in the short term. The New Zealand dollar continued to decline after the overnight consolidation. During the Asian trading session today, the Kiwi dollar pair was trading in the range of 0.61 and 0.6150. Given the strong bearish momentum, the Kiwi decline is likely to continue towards the technical support level of 0.6080, with a subsequent range of the important psychological level of 0.60. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.